This briefing begins with a simple observation. Advanced economies do not fail loudly. They strain quietly, through spreadsheets, funding ratios, and emergency facilities few outside finance ever read. Britain is not collapsing. It is revealing. What appears as a national problem is a systemic signal emerging from decades of financial expansion colliding with demographic reality. Debt did not explode overnight. Obligations accumulated slowly, masked by low interest rates and rising asset prices. When the price of money changed, the arithmetic surfaced. The significance is not the size of Britain's numbers, but the structure behind them. Pensions, sovereign bonds, currencies, and central banks are now bound in a single feedback loop. Stress in one converts immediately into pressure on the others. Interventions no longer resolve imbalance, they redistribute it. Each stabilization measure narrows future choices while preserving the appearance of control. This is why the British case matters beyond its borders. Similar balance sheets exist elsewhere, built on the same assumptions and exposed to the same constraints. The sequence unfolding here will not remain local. It will repeat, jurisdiction by jurisdiction, adjusted for scale and privilege. The purpose of this briefing is orientation, not alarm. The mechanics are visible in markets. Number 1. Britain as the canary system. Britain stands as the cleanest live case study of an advanced economy reaching the limits of financialization. Its structure is uniquely exposed because its growth model depends less on production and more on the expansion of balance sheets. Over the past 4 decades, Britain dismantled much of its industrial base while transforming into a service-led, finance-centered system. The City of London became not merely a national asset, but a global hub through which international capital flows, derivatives clear, and offshore funds transit. This concentration created prosperity during times of low volatility, yet it also embedded systemic fragility. The British economy's sensitivity to fluctuations in global liquidity makes it the earliest signal of pressure whenever monetary conditions tighten. Britain's vulnerabilities are therefore not anomalies. They are early indicators of what happens when debt saturation and demographic strain converge within a currency that lacks global reserve privilege. The United Kingdom occupies a precise midpoint between 3 larger macroeconomic regimes. The United States can defer its reckoning through dollar dominance and external demand for its debt. The Eurozone distributes risk across multiple sovereigns, masking individual insolvency behind a shared currency. Japan absorbs imbalances internally through high domestic savings and policy cohesion. Britain shares elements of each, yet possesses the protections of none. Its currency is fully free-floating, its fiscal authority is independent, and its trade position is persistently negative. When global rates rise, sterling weakens. When markets fall, domestic balance sheets contract. When confidence slips, capital outflows accelerate. This triad of feedback loops, currency, credit, and capital, amplifies stress faster than in larger or more insulated economies. For analysts tracking systemic contagion, Britain provides real-time data on how policy constraints translate into market behavior once the cost of money ceases to be zero. Monitoring Britain is therefore a form of early warning. Pension stress, gilt market liquidity, and central bank interventions offer insight into what other economies will face as their own buffers erode. The pension crisis of 2022, where liability-driven strategies imploded under bond volatility, was not a quirk of regulation, but a preview of structural fragility. Similar exposures exist in North American and European funds, but remain masked by temporary stability. Britain's openness, no capital controls, transparent markets, immediate price discovery, makes it an empirical model of what happens when decades of leveraged prosperity confront the arithmetic of rising yields. The lesson is mathematical, not political. Britain's experience shows that when an economy's foundation depends on the perpetual expansion of credit rather than the generation of productivity, adjustment arrives not through policy choice, but through forced repricing. The United Kingdom is simply the first to meet that boundary in full daylight. Number 2. The $50 trillion number, what it actually represents. And the headline figure aggregates economically distinct obligations into one composite estimate, which masks important differences in legal status, liquidity, and time profile. Public sovereign debt is measured and priced daily in liquid markets, yet it is complemented by a large body of private credit, whose servicing depends on employment and income stability. Corporate leverage sits against operational cash flows and credit lines, whose availability is contingent in stress. Pension promises are actuarial constructs dependent on assumptions about mortality, returns, and wage growth, and they behave like contingent sovereign claims when scaled. Unfunded healthcare obligations and social guarantees create transfer flows that are not always explicit on balance sheets, but have fiscal consequences. Off-balance sheet exposures and contingent liabilities for banks and public-private projects increase the effective claims set against national balance sheets. Derivative notional amounts are large, but their risk is concentrated in nettings and counterparties. Counterparty failure can produce cascade effects that convert contingent claims into realized losses. This composite view reframes the 50 trillion number not as a single bill, but as a network of interdependent promises and exposures. The conversion of those aggregated amounts into systemic strain depends on two structural multipliers that have shifted since the low-rate era began. Demographic aging increases the present value of pension and healthcare commitments and simultaneously reduces the worker-to-beneficiary ratio that funds pay-as-you-go transfers. Sluggish productivity growth compresses potential output and the fiscal base available for servicing obligations. Normalization of interest rates raises discount factors and simultaneously depresses the market value of long-duration assets held by insurers, pension funds, and sovereign investors. Duration mismatches become revaluation channels. Liabilities reprice upward, while asset cushions fall in market terms. Liquidity frictions amplify that revaluation when forced selling begets price impact and then margin calls. The low-rate era therefore created both the incentive to promise more and the illusion that commitments were manageable. The reversal of those assumptions transforms headline totals into operational problems. Policy levers that bridge gaps are exhausted in varying degrees and come with predictable trade-offs. Fiscal consolidation reduces flows but requires either growth or politically painful transfers that can depress demand and output. Restructuring or haircuts on obligations resolves nominal mismatches but erodes contractual certainty and raises borrowing costs for years. Financial repression and yield management transfer value from savers to borrowers, but risk capital flight and long-term distortion. Monetary expansion erodes real burdens through inflation, yet damages saver wealth and can precipitate currency depreciation. That raises external obligations. Central banks face credibility constraints when attempting yield control while maintaining exchange rate stability. Legal and institutional frameworks limit unilateral solutions and create pressure for coordinated regimes, which are slow and politically fraught. Practical monitoring therefore requires close surveillance of gilt market liquidity, pension fund valuation practices, cross-border funding lines, real wage trends, and central bank communications. These indicators will reveal whether adjustments proceed smoothly through market pricing or force abrupt, administratively painful interventions that reallocate losses across populations. Number 3. The pension trap, where the system quietly breaks. Legacy pension arrangements concentrate long-duration liabilities within institutional balance sheets and public expectations. The present value of promised benefits depends critically on discount rate assumptions that were artificially suppressed for an extended period, which made large future payments appear manageable on paper. As yields remained low, many schemes adopted liability-driven investment profiles that matched long-duration liabilities with long-duration government bonds and derivatives to immunize accounting metrics. That strategy reduced measured volatility in benign conditions, but created acute vulnerability to rapid repricing. A sharp rise in yields forces mark-to-market losses on assets intended to hedge liabilities, while margin and collateral calls on derivatives produce forced sales into stressed markets. Those dynamics convert actuarial mismatches into liquidity crises and political problems almost overnight. turning solvency mathematics into administrative emergency responses. Pension funds are large, stable buyers of long-duration securities, so their forced de-risking reverses a major source of market demand and propagates price dislocations across asset classes. Central bank interventions can provide temporary accommodation, but they also alter incentive structures by creating an implicit expectation of support that affects portfolio construction. The drivers of the pension trap are structural and broadly shared across advanced economies. Population aging extends expected payout horizons even as worker-to-retiree ratios decline, increasing the fiscal burden on pay-as-you-go systems and pressuring funded schemes to carry larger cushions. Regulatory frameworks that emphasize near-term funding ratios and sponsor covenant assessments can precipitate cliff-edge funding demands when market conditions deteriorate, creating a procyclical feedback loop. Sponsor weakness transmits risk to corporate balance sheets, raising default probabilities and reducing investment capacity. Bank exposures and insurer guarantees can amplify losses through counterparty channels. Cross-border funding mismatches and reliance on foreign currency liabilities add an external dimension that converts domestic pension stress into a broader financial stability problem. Actuarial assumptions that understate longevity improvements or overstate future returns widen funding shortfalls over time, while wage stagnation constrains payroll growth and contribution inflows. Policy lag and political resistance make corrective recalibration slow, so the liabilities compound structurally before reform measures take effect. Choices to resolve the trap are economically coherent but politically constrained, and each option reallocates risk rather than eliminating it. Higher employer and employee contributions improve funding metrics but reduce disposable income and corporate cash flows, depressing demand and potential growth. Benefit reform and indexation changes reduce liabilities, but breach contractual expectations and carry legal and political costs. Converting defined benefit obligations to defined contribution arrangements shifts longevity and market risk onto households that may be insufficiently prepared, increasing social vulnerability. Monetary and regulatory forbearance can postpone resolution, but increase moral hazard and undermine market discipline. The sequencing of measures matters. Gradual, anticipated adjustments impose smaller macroeconomic costs than abrupt, crisis-driven actions. But political cycles often favor delay. Institutional failure often appears as administrative measures, indexation freezes, reprofiling of benefit schedules, or emergency fiscal transfers that make contingent exposures explicit. Those administrative conversions ultimately determine which economic cohorts bear the realized cost and the political fallout thereof. Number 4. Central banks at the end of optionality. Central banks have served as primary shock absorbers for decades, but the effective scope of their interventions has progressively narrowed as balance sheets swelled and policy rates were held at low levels for extended stretches. Tools deployed in emergencies, large-scale asset purchases, long-term funding facilities, and explicit forward guidance migrated toward normalized policy practice. Those interventions suppressed term premia, supported asset prices, and reduced measured volatility, creating incentives for longer duration positioning across institutional portfolios. Over time, reliance on central bank accommodation altered market structure. Dealers reduced balance sheet capacity for warehousing risk, passive and liability matching strategies expanded, and the marginal buyer of long-dated securities often became the central bank itself. That structural dependence increases the fragility of price discovery and concentrates the policy burden in monetary authorities whose mandate and instruments were not originally designed to manage prolonged distributional outcomes. The choice set confronting monetary authorities is constrained by interaction effects across fiscal space, institutional exposures, and external balances. Tightening policy to restore price stability raises discount rates and therefore increases the present value of long-duration liabilities. This produces immediate valuation losses on assets that insurance companies, pension funds, and some sovereign portfolios use to hedge commitments. Those valuation losses generate margin calls, collateral squeezes, and forced selling that amplify dislocation, which in turn pressures authorities to provide liquidity backstops or to delay normalization. Conversely, preserving accommodation to avoid those losses undermines currency credibility, reduces the real return to savers, and encourages portfolio shifts into riskier assets that inflate valuations and create longer-term instability. Yield curve control and explicit targeting of borrowing costs can cap immediate market stress, but do so at the expense of sterilization complexity, fiscal monetary entanglement, and increased political scrutiny that limits discretionary action. Operational constraints are visible in market behavior and institutional reactions, and therefore define practical monitoring priorities. Persistent widening of swap spreads and secured funding rates, sudden reductions in market-making capacity in long-dated securities, waves of de-risking among liability-driven investment strategies, and recurring episodes of margin compression are symptomatic signals that optionality has eroded. Central banks retain the ability to design targeted liquidity operations, temporary repo facilities, and limited asset purchases to blunt acute dislocations, yet those interventions change incentive structures and increase political dependence on monetary backstops, narrowing future choices. The endgame is administrative: ad hoc supports, coordinated fiscal backstops, and eventual transfer mechanisms that convert financial losses into budgetary or distributive decisions. These processes redefine which sectors absorb losses and determine the political economy of adjustment. Consequences. Number 5. Contagion mechanics. How this reaches your country. Financial contagion does not rely on identical domestic conditions. It propagates through structural linkages embedded in the global financial system. Britain's strain transmits outward through 3 main channels: capital markets, currency markets, and institutional balance sheets. The first channel operates through global asset allocation. Pension funds, insurers, and sovereign portfolios are cross-holders of similar instruments, sovereign bonds, long-duration credit, and derivative hedges, whose valuation and collateral requirements move in tandem when yields shift. A repricing in one major bond market changes risk metrics and margin demands across others, forcing sales or hedging adjustments that tighten global liquidity. The second channel is currency. A weakening sterling against the dollar or euro induces portfolio reallocations that strengthen the latter currencies temporarily, but raise import costs and inflationary pressure in other jurisdictions. The third channel is institutional confidence. When one developed market requires central bank backstops to stabilize its pension system, other markets with comparable exposures are re-evaluated by investors, leading to risk premium adjustments even before local fundamentals deteriorate. Contagion begins as a repricing of probabilities rather than an observable crisis. Dollar dominance amplifies this transmission. Global funding markets rely heavily on short-term dollar liquidity, regardless of the location of underlying assets. When stress increases, non-US institutions scramble for dollar funding to cover margin calls and collateral requirements, bidding up offshore dollar rates and widening cross-currency basis spreads. Central banks outside the United States often lack the reserves or swap line access to offset these pressures, leading to local currency depreciation, imported inflation, and rising domestic interest rates. That feedback loop pushes governments to defend exchange rates or absorb energy and commodity cost increases through fiscal transfers. Emerging markets experience the impact first because their borrowing is often denominated in foreign currency and their institutional buffers are thinner. Advanced economies follow later as investors reassess sovereign credit profiles and the sustainability of entitlement-heavy budgets. The process is sequential but systemic. Institutional behavior under stress determines the depth of contagion. Large asset managers respond to liquidity risk by selling the most liquid securities, usually government bonds of countries perceived as safe. The result is paradoxical. The assets considered risk-free become the primary source of liquidity extraction, producing temporary dislocations even in benchmark markets. Central banks respond with swap lines, repo facilities, and emergency lending. but those tools redistribute rather than eliminate risk. Each intervention signals vulnerability, inviting further scrutiny from markets seeking the next weak node. Over time, contagion manifests not only through market volatility, but through policy convergence. Nations replicate one another's responses. Yield controls, pension backstops, capital flow management, reducing diversity of policy tools and increasing correlated outcomes. The same demographics, leverage ratios, and asset dependencies exist across North America, Europe, and developed Asia. Only the timing differs. Britain's experience thus serves as the template for a global sequence already underway, where liquidity stress, pension fragility, and fiscal exhaustion intersect, making contagion less an external shock and more a synchronized repricing of the developed world's entire financial architecture. Number 6. Political responses are predictable. When financial strain exposes structural imbalances, governments respond within a narrow range of predictable behaviors shaped by institutional incentives and public perception. The first stage is rhetorical containment. Officials emphasize stability, describe volatility as temporary, and project confidence in policy fundamentals. Communication aims to preserve expectations, not to resolve balance sheet problems. The second stage is administrative absorption, where authorities deploy targeted interventions disguised as technical adjustments. These include liquidity operations, temporary guarantees, and selective relaxations of capital or collateral rules. Such measures stabilize immediate dislocation, but entrench moral hazard by signaling that state support will follow market stress. Public disclosure remains limited, and the scale of exposure is often understood only through subsequent parliamentary or audit reviews. This stage can last months or years, during which economic losses are socialized gradually through inflation and reduced real returns rather than explicit fiscal transfers. As market pressures persist, governments transition into distributive management. They attempt to reallocate losses across constituencies while maintaining nominal control of the narrative. Inflation becomes a primary adjustment mechanism, eroding debt in real terms without formal restructuring. Taxation policies are recalibrated to capture deferred revenue from assets or income perceived as undertaxed, often framed as fairness measures rather than emergency financing. Financial repression follows. Interest rates are held below inflation, regulatory frameworks channel domestic savings into government debt, and capital mobility is quietly restricted through macro-prudential rules rather than explicit controls. These measures create the appearance of order, while transferring value from savers to borrowers and from private to public balance sheets. Public resistance arises when living costs rise faster than wages, forcing further political trade-offs between credibility and stability. Policymakers rarely reverse these steps quickly. Doing so would reveal the fragility they sought to conceal. In the final stage, structural adjustments occur under duress rather than design. Pension reform, entitlement recalibration, and public sector consolidation are implemented not as proactive strategy, but as crisis management. Political cycles shorten as incumbents absorb blame for long-term dynamics they cannot control. Voters demand intervention, yet available tools redistribute rather than generate wealth. States that retain monetary sovereignty rely on currency debasement and domestic financial repression. Those within currency unions turn to fiscal transfers or supranational assistance. Across systems, the pattern is uniform: delay, absorb, distribute, and administer. Political narratives will differ, but the underlying mechanics will not. Britain demonstrates this sequence in real time. Other economies will follow the same path once their asset markets and pension systems reach similar thresholds of stress. The timeline varies. The choreography does not. Number 7. Pattern recognition. Why this keeps repeating. Across advanced economies, the same structural template produces recurring financial instability. Debt accumulation consistently outpaces productivity growth, and demographic shifts erode the base that sustains fiscal promises. Governments, confronted by slow growth and political expectations, rely on financial engineering rather than structural reform. The resulting system is designed for liquidity, not resilience. Asset inflation becomes the primary vehicle of perceived prosperity, substituting rising valuations for real output gains. This configuration endures as long as interest rates remain low and trust in sovereign debt persists. Once either condition changes, the underlying arithmetic reasserts itself. Britain's current exposure is not a deviation, but an iteration of a sequence seen previously in Japan's deflation trap, the Eurozone debt crisis, and the late stages of US monetary expansion. Each episode differs in local context but shares the same lineage: excessive leverage, duration mismatch, and political reluctance to impose losses explicitly. The repetition arises from institutional incentives embedded within modern governance. Policymakers prioritize short-term stabilization because electoral cycles punish visible austerity and reward credit-driven expansion. Central banks, nominally independent, operate under mandates that compel them to protect employment and financial stability, which effectively align them with fiscal interests during downturns. Financial markets interpret this alignment as an implicit guarantee, reinforcing leverage and risk-taking. Over time, policy responses that once mitigated crises become sources of future fragility. Quantitative easing, zero-rate policies, and regulatory relief all produce diminishing returns but carry escalating side effects. As interventions multiply, the boundary between market pricing and administrative control blurs, creating a hybrid system where liquidity conditions depend on policy expectations rather than fundamentals. The result is self-referential stability, tranquil until credibility falters, then abruptly unstable once confidence breaks. The persistence of this cycle reflects the absence of political capacity to distribute real losses transparently. Modern states depend on complex promises, pensions, healthcare, income guarantees, that require sustained growth to finance. When growth slows, authorities rely on credit expansion and asset appreciation to simulate prosperity. This process delays reckoning, but deepens imbalance. Britain's predicament illustrates the convergence of these forces: mature demographics, high debt, and asset dependence interacting with the withdrawal of monetary accommodation. Other nations occupy different points on the same curve. The pattern will persist until political systems develop mechanisms to reconcile promises with productive capacity rather than financial leverage. History suggests that adjustment rarely occurs through deliberate reform. It arrives through forced repricing, institutional change, and the gradual erosion of assumptions that defined previous decades of policy. Recognition of the pattern offers foresight, but not immunity. The system repeats because its incentives remain unchanged. Britain's condition should be read as an exposure event rather than a terminal failure. The figures attracting attention represent accumulated obligations meeting a higher cost of capital, not a sudden loss of capacity or competence. Adjustment is occurring through markets first and administration second, which is consistent with open financial systems lacking capital controls. The significance lies in sequence, not magnitude. When the most transparent system strains, opacity elsewhere should not be interpreted as safety. The assessment for other economies is comparative rather than speculative. Similar liability structures exist across North America, Europe, and developed Asia, differentiated mainly by reserve currency status, domestic savings depth, and political tolerance for inflation. These factors alter timing but do not remove constraint. Bond markets, pension frameworks, and central bank mandates are converging under the same pressures. Where buffers remain, they are being consumed to smooth transition. Where buffers are thin, authorities will prioritize stability over price signals, increasing administrative involvement in markets. Key indicators warrant continuous monitoring: sustained deterioration in long-dated bond liquidity, recurring pension backstops, expansion of central bank balance sheets during tightening cycles, and policy language emphasizing resilience over efficiency are not isolated signals. They indicate a shift from market-led allocation toward managed outcomes. That shift redistributes losses quietly and incrementally, reducing the likelihood of abrupt collapse while extending the adjustment period. The briefing judgment is straightforward. Britain is not exceptional, it is early. The mechanisms observed are transferable and already embedded elsewhere. Outcomes will vary by jurisdiction, but the direction is consistent. Higher administrative control, lower real returns, and constrained fiscal optionality. Systems adapt by narrowing choices rather than expanding them. This process unfolds unevenly, often misunderstood in real time, yet clear in retrospect. The relevance is not predictive precision, but awareness. Preparation depends on recognizing constraints before they are acknowledged.